Hi there, this is Matt Sinclair, and this is the MIP Capital Partners Build to Rent Fund 3 July 2026 financial update. So we experienced strong performance during the stabilized period, and that's defined as the period post-permanent financing in April. So the stabilized period represents May through to the end of July 2026. And we exceeded our forecast in several respects that ultimately generated quite a bit more cash flow than was anticipated. I think a caveat is that we did not incur property taxes or insurance during the May through July period, and that's one of the reasons why just optically the results appear so exceptional. An analysis like this, which I'll share later, is best viewed on a T12, so that's a trailing 12 basis. And so I just want to upfront mention that we need to be mindful of expenses that we know that we will incur in the future. But even if we do factor in the incurrence of these expense items, we would have beat the forecast anyway, just because we had cost savings in several other areas. Another key point I want to bring up is in early 2026, we observed that there was going to be additional supply coming to market in a few of the developments. And prudently, we decided to engage in rent concessions to accelerate the lease up period, just to make sure that we were able to execute our permanent financing in a timely fashion. And it turned out to be a very prudent maneuver. We were able to lease up in a timely fashion and secure high quality tenants. And those concessions expired in June. And as I'll show you, you can see the difference in our collections levels in July, where it exceeded the forecast. And then before I dive into the broader report, just big picture, our main focus for 2026 and really beyond is maintaining elevated levels of occupancy. We're attracting high quality tenants who stay for long durations of occupancy is a really critical point of our business model, given our overall objectives of cash flow generation and being able to pay distributions. And we've been able to exceed our forecast actually with the distribution payments, and I think that's a testament to our ability to execute the plan. A couple key points here. So year-to-date distributions have exceeded the forecast by about 4%. And I think even the bigger thing here is the specifics on the loan that we were able to execute in April. So that's the permanent financing. And again, this reflects the portfolio that was upsized from 36 to 42 houses due to being oversubscribed, which was great. And that, again, gives us some additional operating leverage, which is turning out to be quite favorable. But specifically with the loan, I just thought I'd point this out. It turned out to be 68% LTV, so that's pretty much right where we had forecasted it to be. And we were able to obtain an all-in rate of 6.65%, which is a spread of 2.75% over the 5-year Treasury. Now, what's interesting is, given the spike in treasuries since we were able to secure this strong fixed rate financing, we would be paying an additional $5,000 a month or $60,000 a year if we did the exact same financing with the exact same credit spread today, just based upon the move in the 5-year Treasury. So prudently, we're able to execute the financing and again get off the bridge, which I think proves our thesis correct in really pushing to get houses leased up and occupied sooner rather than later, just to basically reduce interest rate risk. And I'm very happy that we did that, because it would have been a difficult situation if we had to wait in order to execute that financing. So overall, that's a good outcome. So here, I like to depict occupancy and collections right up front, whether it's multifamily or single family. I really think these are critical metrics. You can see with occupancy, we forecast a stabilized occupancy of approximately 95%. And again, that's going to oscillate throughout certain portions of the year, given where leases expire and roll off. There will be a dip, and then other periods of time we would expect it to be above that. So overall, we're targeting 95%. So far, again, given that we've just leased up, we should expect there to be a time period where we exceed 95%, and we have. And so we hit 100% occupancy, full lease up. It was actually in mid-May. And then we did have one tenant move out in early July. And you can see this chart at the top that actually shows it's like a weighted average occupancy just to make sure that we're accounting for all the days in a month, so it's completely accurate. Overall, favorable. And again, we're going to really focus on just keeping that occupancy elevated. Another key point with that is lease up velocity. It's a very underappreciated aspect of this business. But whether you lease up a house in 30 days or 60 or 45 or anything in between, it's going to have a huge impact on your overall vacancy figures. And I think that's something people don't focus enough on. It's something that we're prudently monitoring. And again, we have active applications on the one vacant house and some very strong applications. We're going to make sure that we get a quality tenant for the one house that is currently vacant. The bottom of the page depicts actual collections, which is the darker blue bar, versus the underwritten collections. And I really think collections, it's the single most underutilized thing in single family and multifamily. Collections reflects the amount of cash you're actually getting from tenants, which really is what matters. If you just look at the P&L of a rental property or a multifamily building, there's many things that can obfuscate the cash reality of what you're actually getting, many different types of concessions and so on. But at the end of the day, collections is really what matters. And so, to my point earlier, we did have rent concessions in place that eventually burned off by the end of June. But as you can see, in May and June, our actual collections were a little bit below the underwritten collections. And again, that's just really the effects of some of the rent concessions that we provided to tenants, just in a few selective elements, just to make sure that we were getting in and getting those leased up with quality tenants before the supply wave hit. Because once that supply wave was to hit, it would have been very difficult to secure tenants in a timely fashion, which would have created interest rate risk with an elongated bridge outstanding. In July, we actually collected more than we had underwritten. And that, again, that's because the concessions burned off in June. And then you can see by July, it's more of a run rate picture. And we actually collected more cash than we expected we would. And so that's a positive outcome. And again, we're closely monitoring things right now. But my expectation is by the end of September, so the next report you'll get, there'll be quite a positive trajectory shown with both the charts on this page. Here is what we call a variance analysis. And this is something I'm closely monitoring on a monthly basis. And this table particularly is showing the May through July 3-month period. And on the left side, you can see what was underwritten. And then on the right, you can see the actuals. And so they'll walk you through just from top to bottom what this shows. Bottom line, our net operating income was 26% above expectations. But a key caveat there is really that's just because certain expense items didn't hit in these months. And so we need to take this with a grain of salt. Base potential rent. So there was a few properties where we lowered the rent a little bit. So you can see there's a variance of 1% on the underwritten rent versus what we achieved. And that, given the market conditions, that's actually quite a relatively favorable outcome. And so I'm okay with that. The overall cash impact of that is de minimis. I would say on the vacancy side, we experienced less vacancy. We modeled 5% vacancy. We experienced just the one house that turned, and it overall weights to be 1.1% vacancy. So that's a positive. As you can see, the item labeled number 2. So there's a large concession item, and I wanted to call that out. So that's the net impact within the stabilized period of those concession items. But again, those had burned off in June, and there are no concessions as the beginning of July. So it's very positive. Then working our way down, you can see that revenue overall was 5% less than was anticipated. But again, if you look at the components of what drove that lower than expected amount, it's non-recurring. And by the time I'm showing you and walking you through the report as of Q3 2026, I think that we'll see a reversal in the revenue trend. And walking down to the expense items, and this is really what, in the current environment, a prudent single family or multi-family operator focuses on. If you're in 2021, say, and you're in a market environment with tight occupancy, the best strategy is to really push for rent escalation, because tenants will have fewer choices and they will pay higher rents. In the current environment, I wouldn't say it's a soft market, but it is a sideways market currently. and there is a bit of an uptick in supply, going for high rent increases would likely create more vacancy and more vacancy expense and turn expense specifically than any benefit that one might get from rent increases. And so the best thing to do in the current environment is to solve for occupancy, which is going to maximize cash flow generation. And so in doing that, that implies that our top line is going to be dictated by the marketplace and somewhat fixed. We'll get reasonable rent increases over time, but we're going to make our money through cost management. As I alluded to earlier, there's a couple of big expense items here where there are zeros, and that's really just because we didn't incur those things in this stabilized period. We will later in the year, and so just want to make it clear we have budgeted for those. And so the way that I model this, I model each and individual property as if it's a separate business to really evaluate and dig in the merits of that given property is to make sure that we're only buying the best opportunities that are out there. So for every property that we underwrite, it's only some small proportion that we actually will end up purchasing. And a lot of that analysis is really just a top to bottom analysis of rent all the way down to revenue, and then all the different expense items, including property taxes and insurance and so on for each individual house. Then the way the model works is it rolls each and every house up into an overall consolidated model by tranche. So we took down houses in several tranches over the course of a number of months. We did that just to facilitate lease up velocity. If you were to take down all the houses at once, it would be very difficult to lease them. But if you take them down prudently at intervals, you're able to capture the demand that pops up every few months within a given submarket. And that's why we're able to achieve favorable lease-up velocities. That then rolls up into a consolidated model. So just practically in rolling forward in a stabilized period, it equates to, it's actually 72%, it's precisely 71.8% on a net operating income margin. That's the forecast. And then that margin is maintained, and we roll things forward with a rent increase over time, which such that the amount of net operating income over time is increasing. But we make sure that we're comparing our actual results at different time periods, ultimately stretching to a T12 time period, again, against this baseline of 72%, just so that we're always cognizant of where our money's going. And as you can see here, several items came in below forecast. So we actually would have beat the forecast even if we had incurred property taxes and insurance within this 3-month time period. Here is the second part of the variance analysis, and something that I think the most important metric in all of single family and multifamily is really net operating income less capex as a percentage of revenue. It's basically talking about how much revenue are we converting into cash. A lot of operators won't include capex measures in information they disclose. For me, I think it's of paramount importance, and really what becomes an operating expense item or a capex item is really just based upon the size of it. And so for costs that are $2,500 or greater, we capitalize those expenses, and so it wouldn't be on the income statements, and it's in the cash flow statement as a capex item. That's just really in alignment with the IRS de minimis safe harbor guidelines. But if I'm thinking about this just as an investor and I want to understand where my cash is going, I need to penalize net operating income for this capex amount on a pro forma basis, and then compare that to revenue. So I'm thinking about it in terms of proportion. And so, as I said, we didn't incur some big cost items in that 3-month period. So and net operating income less capex as a percent of revenue is 93%. I mean, that's a pretty exceptional outcome. It is not one that could be sustained. Our target is 68%. But even that would be quite favorable in terms of its cash flow generating capacity if you compare it to single family or multifamily in most jurisdictions throughout the United States. It's really a testament to two things: the cash flow generating power of new construction properties because they require minimal maintenance, and secondly, the specific jurisdiction that MIP Capital Partners has chosen as its inaugural market. You really have very favorable insurance and property taxes. And those two items are huge. And if you're in another market like, say, Florida or Texas, those are enormous, such that your margins will be substantially compressed, which in an environment of elevated interest rates is going to make it much more difficult to generate cash. And so you can see here, item labeled number 4, so turn CapEx. So we did experience one turn, but again, overall, it comes in substantially lower as a CapEx figure versus our run rate assumption for any 3-month period of a stabilized period. Item number 5 here, you can see the implied cost to maintain each house. Again, came in quite a bit below expectations. Really, that's a testament to, we have a very, very good and efficient property management company, and we do a lot of preventative maintenance. So if something comes up, we're on it right away. That tends to actually lessen the amount of cost you'll ultimately have to spend. And again, big picture, the benefits of new construction versus general Class A single family. And the final item I'd mention here, item number 6, EBITDA. So we had an exceptional outcome from an EBITDA perspective. And I like to look at EBITDA because that matters if cash matters. And again, this is before CapEx, but EBITDA is a pro forma income statement item. This really just says that we're very efficient in turning rents into cash. We have minimal overhead, and so every dollar that gets all the way down to net operating income, we're turning that into cash at the top of the cash flow statement. And that's it. Again, like I said, we run lean, very limited overhead, and we're very, very cognizant of costs in our use of what is ultimately investor money. So our overall EBITDA margin of 85%, again, that's exceptional, not to be sustained, but it certainly puts us off to a great start. And we're going to continue to conserve cash and really just make sure that we're each and every month paying out the distributions. And that concludes this update. Again, like I said, I'll provide another update once the September results are available, and I'll communicate that to investors. In the meantime, if you have any questions, I'm available at any time to discuss. And again, thank you very much.